Good afternoon. Um, this is Barry Hersh, professor at NYU SPS Schack Institute of Real Estate. And it is my pleasure this afternoon to host this webinar with Mark Fogel. Mark is the CEO and president of Acres, which includes both a private company and, I just learned, a real estate investment trust, a publicly traded company. Mark is an alumni of the Schack Institute of Real Estate, also a background in accounting. And I was particularly interested in inviting him to speak and appreciate his time and expertise because his firm, Acres, has done very well, as you'll hear more about, through the pandemic. So first of all, Mark is going to have a presentation talking about what he has been doing in describing Acres and a couple of projects. And then we'll have time for some questions afterwards. And I will ask about his forecasts and other items of interest to students. So with that, Mark, I invite you to start your presentation.
Great, thanks, Barry. Thanks for having me, and welcome, everyone. So today I thought I would talk a little bit about Acres and what we do and how we do it, and things that have been happening to us over the last couple of years, especially during the pandemic. And I thought I'd share some of my thoughts on where I'm seeing some opportunity in the marketplace. And then I put together a few slides and some current deals that we're working on that are pretty interesting. I think that they're very fun to talk about, different types of projects that typically most lenders wouldn't get involved in or see. So I welcome questions as I go through those deals, and certainly any questions about the company, I'm here for you to answer. So
1 second, please put questions in chat, and we'll have, and I'll ask those questions after the presentation. Thank you.
So Acres Capital was founded 10 years ago. And the idea behind Acres is to be a lender that focuses mostly on the middle market space in situations that aren't necessarily set up for a bank or CMBS or any other type of lender that plays in the middle market space. A lot of what we do is value add, construction, renovation, rehab, adaptive reuse. And I will get into it in a moment, but we've sort of expanded our offerings into the idea of being sort of that one-stop shop solution in the middle market space. I have a slide a little bit later on that illustrates what I'm talking about. But right now we manage $3.5 billion of investments across the country. As you can see, we have investments in 30 states. Our typical loan size is $10 to $100 million, with the average being about $30 million today. We have 52 people on the team, and that team really consists of originators, screening people, underwriters, asset managers, finance, accounting, legal. We are an SEC registered investment advisor. And as Barry alluded to, we do manage a publicly traded mortgage REIT, which I'll talk a little bit about in a minute. So in the world of lenders in the middle market space, we kind of fall in this place that I'll describe as alternative lenders. The MBA, Mortgage Bankers Association, describes us as non-bank lenders. And if you're paying attention to the market, this segment of the market has grown quite rapidly. I think you could probably count 250 groups that exist today in this space that you probably call debt funds or REITs or other type of lenders that don't fit into these other three buckets: life insurance companies, banks, private equity. So this group of lenders is really more private for the most part, with less regulation, with the ability to do things that are a little bit different than what banks and life insurance companies would typically do: higher LTVs, different asset classes, different structures, some more flexibility. And that's the universe that we live in.
Yeah, a quick note for students, that on this chart, the vertical axis is loan to value, and the horizontal axis is LIBOR +2, +4, up to +12.
Yes. And so I would say that's a little dated. It's not LIBOR anymore. We've been switching over to SOFR. We can have a conversation about that if you'd like, but I'd rather not dwell on that too much. It's become just
Me
a
too.
pain, pain in the neck, but it's actually S +4 and 6 and 8 now. So I mentioned this idea of becoming a middle market lender for essentially the entire life cycle of a loan, being that one-stop shop lending solution for our sponsors. And the people we deal with, if you think about a $10 to $100 million size loan, you're really dealing more with local operators who are entrepreneurs, who have a track record, who probably have a portfolio of 10 to 25 assets. They're really good at what they do in their marketplace, but they're not institutional in nature. They don't have big finance teams. They don't have 200 people in their team. They have 10 and 20 and 30 people teams, but they're really honed in on whatever markets they're in. They understand them probably better than most, and they're very good at identifying opportunity and creating opportunities for us as a lender, which they prefer not to bring to a bank or any other type of situation where there's going to be probably a level of inflexibility or guarantee requirements that they don't want to have. So, it all kind of starts with the left side there where it says Acres Bridge Mortgage Fund. This is really the private side to our company. It consists of funds, our balance sheet. We have some institutional partners on our balance sheet. And what we're trying to do in this portion of our company is to originate deals that are heavy value add. So think of pre-development land deals, ground up construction, adaptive reuse, a redevelopment plan, things that if you take it to your local bank, you're probably going to have a hard time negotiating something that works for a local entrepreneur who's not extremely liquid, doesn't have high net worth. You need a group that's going to be able to work with you and adapt the loan and structure the loan around your particular situation. So that's what we do. We're generally a little bit higher in LTC, loan to cost, a little higher on loan to value. It's certainly more costly, but it's also non-recourse lending. So we don't require principal payment guarantees. We have completion guarantees for completion of construction, but most of the time our sponsors are getting what they call GMP or gross maximum price contracts from general contractors. So it sort of shields them a little bit from overages on the construction side. So once it goes through that process of creation or value add, what we end up with here is a Class A multifamily property or office building or self-storage facility or hotel. And generally what occurs in the marketplace, as you might imagine, is people want to get a cheaper form of capital once they've done the hard part, constructed the building and brought it that part of the business plan to fruition. The next part of the business plan, obviously, is to lease it up and stabilize it. So you can't just go get a permanent loan before you stabilize a property. Permanent loan is typically your cheapest form of capital, but it takes some time to get there. So there's this in-between period between a construction loan or a renovation loan where you need to spend some time renovating, but stabilizing, but you certainly don't want to pay high interest rate in that situation. So we have a publicly traded mortgage REIT, as I've spoken about before. It's called Acres Commercial Realty. We trade on the New York Stock Exchange under the symbol ACR. And we took over this company. It was a publicly traded mortgage REIT that we took over the management of about 2 years ago, with the idea of having this one-stop shop solution where we can take our construction sponsors and borrowers and migrate them into this lower and cheaper form of capital. And so this publicly traded mortgage REIT operates just like any other publicly traded mortgage REIT that's out there. Think of Arbor or Starwood or some of the others that exist in our space, we do exactly what they do, which is we have an equity base, we have common stockholders, we have preferred equity, we have notes, but most importantly, the reason we can charge lower rates while we move it over to the REIT is because we have what we call a CLO market out there that is quite active. Collateralized loan obligations, not sure how much any of you know about that, but it's certainly the cheapest form of debt capital that we can put on our balance sheet. And it's non-mark-to-market financing, meaning that I can't have a lender sort of foreclose on my assets and take control of my portfolio. And it's just probably the best form of financing any commercial mortgage REIT can have on their balance sheet. So the goal is, when the market's hot like it is right now, is to execute on these CLOs. We did 2 of them last year with JP Morgan as our lead banker. In total, it was about $1.4 billion of CLOs that we issued. And our cost of capital on those is about L plus 160 overall at about an 82% advance rate. So that allows you to make loans at 3% and 4% because you end up with a return on your equity in the 12 to 13% area. And that's really kind of the target rate of return that most of the commercial mortgage REITs seek. On top of that, we're working on putting together a permanent lending platform so that when these properties stabilize and they get to the point where they've reached full value, our borrowers don't want to be on these floating rate short-term bridge loans. They want to convert it to a long-term piece of paper, typically 7 to 10 years. In the case of HUD loans, could be up to 40 years. So we're building out a platform right now so that we can take our borrowers from this bridge loan over to the permanent side once they reach that valuation that they're seeking. And something to think about, and I think I mentioned it on the slide later on, as rates continue to rise, which I think they will over the course of the next 2 years so that the Fed can sort of harness this rising inflation rate. I think there's going to be a lot more people migrating over from these first couple of columns, these floating rate bridge type deals, over into fixed rate permanent debt. Because if you think rates are going to continue to rise, your goal is to lock into long-term perm debt now. Floating rate debt's been very popular over the last couple of years because it's been very cheap, but that level of cheapness is going to go away at some point. So I thought I'd talk about some of the things that I see as maybe opportunities or situations that I'm seeing in the market right now that obviously come across my desk. I have to pay a lot of attention to what I think right now is a very transitional market. There's a lot going on. Obviously there's a big situation in the Ukraine. Oil is going through the roof. There's a lot of inflation out there. The Fed's raising their rates. So that makes the market very active as compared to what it's been for the last couple of years. On top of that, you have the end of forbearance and the ability to now have lenders foreclose. There was a moratorium in most jurisdictions on foreclosures, which means that me as a lender cannot exercise my rights and remedies to take over the property if my borrower defaults. And so because of that, assets like hotels and office buildings and retail properties that otherwise might be foreclosed on have been forbeared on by lenders. So lenders are essentially just kind of sticking with the deals because they have no other choice and trying to get what they can out of them while this foreclosure moratorium is in place, which now is now going away in most jurisdictions. So here I am in New York. I couldn't foreclose on a property for the last 2 years. And so my hands are tied. If I'm getting no return on my investment because our borrowers have no cash flow coming to their property, I have no debt service either. So what's going to start to happen, I think, in the next year or two, is all the lenders that couldn't foreclose before are going to create a flood of foreclosures in the court systems. And that's going to create a lot of transaction volume in office, in retail, and hospitality on assets that were in default. You didn't see it in the multifamily sector. The multifamily sector stayed very strong. You're not going to see a lot of foreclosures in multifamily, but you will see it in the other asset classes. So me as a lender, what do I think about? Well, multifamily's kind of been played out. So let me think about some of these other asset classes where you're going to see a flood of, I think, transactions coming onto the market. At the same time, some of these gateway cities, as you know, have been hit really hard by the pandemic. New York, San Francisco, and Chicago, to name a few. And I see that as opportunity. New York office values and San Francisco office values and hotels have been reset. Whereas an office building might have been worth $600 a square foot before the pandemic, it might be worth $400 a square foot now. And so me as a lender, I think about if this is the right time to get in at that basis and whether or not there's a feasible business plan for any of these properties. Is office going to bounce back the way it did in New York? And if it's not, what's going to happen? So I have to think about not just the market bouncing back, but the way office is going to look in the future, what kind of leases can be signed, what kind of rents can be garnered. And the same can be said about hospitality. It's like, is hospitality going to bounce back the same way it looked before the pandemic? Retail, for sure. Retail was on the decline even before the pandemic. So I'm thinking about situations where good investors, like I mentioned before, people who are close to their markets, see opportunities on retail properties that are in very good locations to create value and do some adaptive reuse of those properties so that what became an obsolete dead asset becomes something that's valuable. I mean, we have some examples here, even on Long Island, where we're based. Sears sits in the middle of Hicksville, which is dead center in the middle of Long Island, right off the train line, and it's 50 acres of property that's invaluable. It's hard to find that kind of land here on Long Island. So somebody's going to do something with that, and certainly I'd like to be the lender on a property along those lines. And then, of course, you've got rising interest rates. I already mentioned this idea of going away from floating rate type loans into fixed rate permanent lending type solutions. And that's the reason that we're looking at building out this permanent platform so that, in times when there's less floating rate bridge lending going on, we focus a little bit more on perm and vice versa. So that's in the hopper. We're going to hopefully offer something that's pretty unique to the permanent lending world. We're trying to not do what looks like CMBS. If you know anything about CMBS, borrowers don't necessarily like CMBS. The only thing they like about it is its cheap pricing, but everything else is a kind of a pain in the neck. And God forbid you run into a problem on your CMBS loan, you're gonna have a hard time working it out with a servicer or a special servicer. So we're trying to create a situation where you're talking to us, we're the servicer, we're the special servicer. We create a flexible solution that isn't locked into the confines of a CMBS trust. So Barry, I'll pause there. I don't know if you had any questions on everything I just talked about, but I was going to get into some actual deal opportunities for the rest of the.
Well, I did get one question, which is whenever there's been anticipation of a flood of defaults, owners get very creative in ways of hanging on to their property. But there will be short sales and other ways in which owners will choose to extricate themselves rather than going into foreclosure. Do you look for those kind of opportunities?
Yes, of course. So foreclosure is one route by which another investor will come in and potentially buy the property at a low basis. But the other route is a short sale for sure. So if a sponsor is about to get foreclosed on and he negotiates a short sale with the lender, there's going to be a buyer, right? So the buyer needs financing. And so I would be the lender on that type of situation and a workout situation as well. I have somebody calling me right now that's, he's got a deal that he worked out with his existing lender. I need this much in the way of money to get rid of them because they're breathing down my neck. They're about to foreclose. Can you write me a loan? And so, that's opportunity. If you think about it from a lender's perspective, you got a borrower that's stuck. And you can create a pretty good rate for yourself in situations like that, but it solves everybody's problems. It gives me a good rate. It gets the other lender off the hook, and the borrower gets to live another day.
Okay. All right. Why don't you go ahead with your examples?
Yeah, so I thought I'd talk a little bit here about a deal that we got into several years ago, and the pandemic kind of halted the plan that was originally contemplated by our sponsor. Our sponsor bought a piece of land, and as you can see there on the left, the land came with a structure that was heavily damaged by a hurricane many years ago. And his idea was to take that structure and rebuild on it and put a Marriott Autograph hotel on the ocean in Daytona Beach shores. There's no Marriott on the water in Daytona Beach shores, and Daytona, it's had its ups and downs, but it's actually gained a lot of momentum over the last year or two as Florida has just blossomed. Certainly Daytona is the cheaper alternative to go into Miami Beach or West Palm or some of those other places. And so, it's really in need of a 4-star or 5-star type hotel, because Daytona generally has 2- and 3-star, if not 1-star hotels along the water. Not to mention, you only have an hour commute to Orlando, to Disney World. And so that synergy between the Marriotts in Orlando and the Marriotts on the water is something that works pretty well. So when we got into this deal as a lender, our borrower bought the property for I want to say $20 million plus or minus, and we gave him money to do some pre-development work to get the Marriott Autograph franchise signed up, get the architectural drawings done, and get it to a place where he was fully permitted and ready to build. Unfortunately, the pandemic destroyed his dreams. He defaulted on our mortgage, and we entered into what I'll call a friendly foreclosure. He really had no out. Rather than me sue him personally under some of the clauses in which I could potentially go after him, he basically just handed me the keys to the property. The city of Daytona, as you might imagine, was a little bit concerned. They were tired of looking at this eyesore. They had been excited about Marriott Autograph coming into place, so they called me up and asked me what my plans were. And at the same time, Marriott called me up and asked me if we'd like to move forward. And at the same time, a hospitality company that's pretty big, a very large developer of hotels in this country, called me up and said, look, there's an opportunity here to follow through with these plans. So we started going down that road. And as many of you might recall, and I'm sure you do, there was a collapse of a condominium in Miami called the Surfside Condo. That spooked a lot of people. That structure was old, dilapidated, and it collapsed. And so the city of Daytona came to me and said, well, Mark, there's no way we're going to let you build on this existing structure right now, because God knows there's defects in the concrete and the steel. And if that falls, we look really bad as a city having let you build on an existing structure that's that dated. So I said, well, that's not good, because that structure is worth $10 million of construction cost. And so I can't have that just taken away from me. I can't just demolish it without something in return. So the zoning for this property and a development agreement allowed for what was 229 hotel units and 70 condo units. And so my response to them was, well, look, if you can give me more zoning, give me better zoning, allow greater bulk on these properties, I might be willing to trade that for taking down the building. And that's exactly what we did. We entered into what I would call a record time negotiation with the city. And by the way, all this had to get blessed by the state as well, to get a new development agreement put in place. So I was able to upsize the hotel key count from 229 keys to 300 keys. And I upsized the condo count from 72 keys to 200 keys. On top of that, I was able to increase the height restriction from what was 15 floors to 23 floors. And so you can imagine what kind of value that might add to your bottom line if you really believe in the city of Daytona. It certainly outweighs the $10 million of construction costs that I'm foregoing by knocking down this tower. So the quid pro quo was, you knock down the tower, we sign this development agreement, which stays in place and it's law for 30 years. And that's where we are right now. During this whole process, though, we were approached by sort of a different brand that's not Marriott, that is actually a better brand and more valuable in Daytona Beach. And so we're in negotiations with those guys right now. Suffice it to say, we could turn what was a very difficult situation on a $20 million loan into, I don't want to guesstimate, but a return that could be north of $150 million to our firm if we build this out and follow through with the plan. So when you're a lender, and my background is asset management, that's what I've done. I've worked through a lot of stuff. You always have to think about these situations of what can go wrong. And if it does go wrong, what's your fallback? You never make a loan unless you know you're prepared to own it and follow through with something that makes sense. And in this case, we got lucky. We got a city that was desperate and in need of getting rid of an eyesore on 5 acres of beachfront property. And at the same time, we have a flag that's perfect for Daytona approaching us about this site in something that we now can put 500 units on versus 300.
Okay. Quick question. When this first came on, the very first thought I had was about the building that collapsed.
Mhm.
And it's interesting how that played out. But in the redesign in the new building, what are you doing to protect it?
Right. So on the right, you see the rendering for our potential new building with the hotel on the right and the condos on the left. Basically, it's going to be a brand new concrete piling with pilings in place in accordance with new Florida code. I mean, Florida's updated their code now since the Surfside collapse. So basically, you'll have the latest in technology and the newest code in place for the construction.
Okay, thank you.
You're welcome. Another situation kind of revolves around this idea of adaptive reuse. This is more a story about a sponsor in our system, a borrower in our system, that if you look at this map, this is King of Prussia, Pennsylvania. For those of you who are not familiar, this is about 20 minutes, 25 minutes outside of Philadelphia. This area has been the site, this particular site has been the home of basically an office and industrial complex that is quickly being turned into a life sciences and lab space hub in the mid-Atlantic. As you can see down below in that bullet point, we call it Silicon Valley. It's this concept of lab space and biotech space has been booming in Boston and in San Francisco, but Philadelphia boom started a few years ago when our sponsor, our borrower, lured the University of Pennsylvania biotech leader out to this neck of the woods. There was an old Glaxo headquarters out here that he converted to this office and lab space. And that's been sort of the anchor to convert all of this office and industrial space into biotech lab space. And the reason you change that use is because office leases generally in this market are $20 to $25 a square foot. Biotech and lab space is generally $50 to $60 a square foot. Of course, it's expensive to do that, but the returns certainly justify the investment you'll make in converting these buildings. And so it's really booming now because this area is looked at as a cheaper alternative to Boston and San Francisco, where you might have to pay $120 a square foot for lab and biotech space and life sciences space, whereas here it's $50. And at the same time, you've got great universities around here. You've got Villanova right down the block. You've got University of Pennsylvania. You've got Temple. You've got Drexel. There's a great reason for people to locate their companies to this market. when they're focused on biotech and lab. So our borrower approached us about investing in an existing office building, about 100,000 square feet within this park that you see, and buying it with him and converting that to this life sciences lab space. So that's in process right now. If you look at the value as an office building, probably $25 million. We were able to buy the building for $13 million because it had an expiring lease with the Nuclear Regulatory Agency. So we bought it cheap. At $13 million, that's $130 a square foot. And if you put the money in, which will probably be something along the lines of $150 to $200 a square foot for capital work, tenant improvements and leasing commissions, your all in is probably $45 to $50 million, but you end up with a valuation close to $90 million. So that $90 million valuation is obviously compared favorably to your $25 million office spaces. And that's what's going on in this market. So this is all about adaptive reuse, taking something that kind of works in a market and turning it into something that will really work in a market.
Yeah, it is interesting how quick you are. And I would say New York wants to be in that space but probably cannot compete on cost. Why don't you do your last example, and then I have a couple of questions, more general questions in chat.
Sure. So this last opportunity is really, I'll call it like I refer to this sort of as an infill type situation. So Florida State University, obviously you all know it. It's growing rapidly. State universities across the country are growing rapidly just because of the cost of tuition on private schools. So Florida State's just booming. I think growth has been something like 8 to 10% a year in enrollment. It's got about 45,000 students right now. And I think they only have, call it 5,000 school-owned dorms on campus. So almost all the housing for Florida State is off-campus housing. And if you know anything about student housing, the closer you are to campus, the more valuable the property. And what you have, and you can look at on the map here, is on the right, is, I'm sorry, is it still on?
Oh, okay.
Can you see there?
Yes.
What you have there on the right is the campus. Florida State University is to the right. You see the College of Medicine down below. And you know, our sponsors came to us and said, look, we've got these two buildings here that you can see near the blue. One on the left side of the street, one on the right side of the street. We're going to keep one of them as an existing building and continue to operate it. We're going to knock down this other building and we're going to build brand new Class A student housing. The market is so tight and the rate per bed is so high that if you're in an infill location and close to campus, you will occupy this and get it to 100% levels very quickly. And so we're working on a redevelopment play with them on this. And again, this is a situation where there's a lot of value. I think our all-in investment would be $90 to $95 million. And you have the ability to potentially create a structure and properties that are worth $140 to $150 million. So the long and short of it is, you know, buy in the right places and turn what was obsolete older type situations into something more valuable. Okay. That's all I have.
Yeah. Well, the question that I have is about floating rates, a better understanding of your product line. And I assume your 10K is available in the usual places.
That's right.
But are you generally making floating loans as bridge loans or add value loans?
Everything we do is floating rate loans. You know, we borrow money from CLOs and line lenders and others that are all on floating rate. So you have to kind of match your cost of capital to your investment returns. So they're all on floating rate. So as LIBOR or SOFR continues to climb, our cost of capital climbs, but so do our returns on our investments.
Okay, and there's another question that talks about the difference between the interest income and interest expenses, and says on assets of 1.5 billion, 30 million is 2%. He's asking about the buffer that you have in the event of negative things happening.
Yeah, so the real buffer we have is liquidity. I mean, the only times you can really get burned as a commercial mortgage REIT, well, it's not the only time, but certainly one of the worst things that can happen to you, and it happened during the pandemic, is you're short on liquidity. And the reason that's important is because you have these lenders and these CLOs that provide you financing. And sometimes when the market changes dramatically, loans go sideways, loans go bad, or the lenders ask you to pay off the loans because they don't want these bad properties on their lines, and they have the ability to do that. So they mark down the value of the asset and they say, you got to take this off the line. So the one thing we did when we came in here was we brought in these facilities of $400 million of cash that allow us to deal with difficult situations just like that. So what you don't want to do is when the market's sideways, what you saw a lot of the REITs do was selling off their assets at discounted prices and losing shareholder equity. We don't want to do that. What we want to do is take over the assets or forbear on the assets and wait for a better time when we can create the value and not sell in panic into the market. So liquidity is really the key to ensuring that those situations don't happen. And you can name the REITs across the board that had to go get money, TPG, Granite Point, others. They had to go find money to ensure that they could meet their obligations under these facilities.
Okay, but loans do go bad.
They go
You've
bad
had
all the
that
time.
happen.
Yeah, my job is to make sure that I know when they're going to go bad, or I sense that they're going to go bad and get ahead of it.
Okay, I have a different type of question that came in. It was something that you and I had discussed once earlier, which was PACE loans. And in general, energy efficiency and sustainability, but specifically with PACE loans, the first mortgage holder, which you often are, has to allow someone, the owner, to take a PACE loan. I want to know if your attitude about that has changed in the last couple of years.
Not really. I think PACE is a good thing. I think it's helpful to sponsors, particularly in our space. But the way PACE works is it's basically a lien that's ahead of your first mortgage, and so you can almost think of it as a property tax payment. Because if I ever have to foreclose on a property, I have to keep the PACE loan current. Otherwise, that lien can essentially damage my position. So it's a little bit like a ground lease in that way. So it's dealing with another party that makes things very complicated for me if things go sideways. So I'm not a fan of situations where there's other parties involved that can potentially hurt me or stop me from exercising my rights and remedies properly.
Okay. What about more generally what you are seeing or expecting from developers and redevelopers of property in terms of energy performance, sustainability, certifications, any of the movement towards energy efficient, sustainable real estate?
Well, as you're probably aware, so many investors, especially pension funds and the like, are hyper focused on those issues. And if you think about where our sponsors, our borrowers are getting their money from on the equity side, it's these institutions that are hyper focused on it. So you're not going to be able to borrow money or draw in equity investors if you can't play by the rules that they want you to play by. So these energy efficient, sustainable type projects are front and center right now because all the capital coming into the space, or a lot of the capital coming into the space, is dead set on the idea that if you're a developer that's not doing that, we're not giving you money. And by the same token, if I'm a lender that's taking money in from these funds, they want me to ensure that I'm focused on it as well. So I don't want to be lending money into situations that aren't essentially giving me a good scorecard with my pension funds with respect to these types of things.
Okay, thank you. So we do have a student who wants to suggest that you go into Europe, that they need you.
You know, one of the reasons people invest with us is because all we do is make first mortgage loans in the United States of America. And there's a really good judicial system, and first mortgage loans have been proven out to be very powerful here in the United States. And, there's not been a lot of changes to that over the years. And if you go over to Europe, and this is without putting down Europe at all, rules change, laws change. Sometimes you're in a good position, sometimes you're in a bad position. I don't understand it enough to put myself out there like that. What I do understand is the way we operate and the way we make loans here in the United States. So, stick to your knitting is the way I look at it.
So there are a couple of property types. Well, you mentioned retail, but not your examples. You're willing to go into the hotel, which is to some degree rebounding.
Mhm.
Are there retail projects that you would do?
Sure. Well, number one, if there's a construction loan to be made on a pre-leased retail situation that involves high level of credit tenancy, like a Target or something like that, certainly we'd look at a construction loan for something along those lines with long-term leases. There's a lot of Amazon supermarkets out there as well, so that's good credit. So we would do that. The other part of retail that I'd get into is, as I said, adaptive reuse. So a lot of regional malls that are somewhat obsolete, people come in and they're converting some of that to, or keeping some of it as retail, but certainly converting the rest of it to apartments, hospitality, and self-storage, gyms, things like that. And I would do that. It's hard to make those work because that involves a lot of cooperation from the local municipalities. So a lot of zoning changes that have to occur for you to be allowed to do that. So if I can get something fully baked with the municipality and permit ready, then that's something I would do. But something that is still speculative, where there's no really known outcome to dealing with the municipality and the zoning and the ability to put other uses on that site, that's not something I would do.
Okay, I appreciate that. Well, I would not be doing my job if I didn't ask this question, which is advice and suggestions for our students about planning their career, thinking about different roles in real estate, and what you think is important for them to learn and where you think opportunities are going to appear.
So I like to tell people when I go to schools that it's really good to start at the I don't want to say the bottom, but on properties. Property management is a really good place to start. Everybody wants to start in high finance on Wall Street, and I think you do yourself a disservice if you do that, because I'm not sure if you really truly get a good understanding of the actual work that you're doing on the finance side when you don't really understand how properties operate. And so, I began my career more on the property management side with a group called General Growth Properties, which was the second biggest mall operator in the country, short of Simon, back in the early '90s. And I learned how to lease properties, how to manage properties, how to look at boiler systems and air conditioning and maintenance, and how you run properties, and really understand what it takes to run a property. And then I got into development at Forest City Radnor. Now, Forest City was at the time one of the biggest developers in New York City. And that gave me the opportunity to see how you build buildings and what goes into building buildings, and construction costs and municipalities and zoning. And so The point of that all is to say that you're probably better off really understanding the real estate from the ground up and the nitty gritty of it before you target the corner office or the, the Wall Street firms, like, doing CLOs or things like that at JP Morgan. And I have great respect for them. They're really good at what they do. But if you ask them a question about the real estate that they're putting into these CLOs, they couldn't answer you, or at least they'd give you the answer that everybody else likes to hear. But they wouldn't really understand what they were saying.
Okay. You mentioned New York, and you moved your offices to Long Island?
Yeah, we've been on Long Island since the beginning.
Oh, okay. So it was a different location in Long Island.
That's right.
Okay. But talk a little bit about the New York market and what you see happening in the region, both Manhattan versus the suburbs.
Well, I think, New York, to me, I've been a big believer, and if you can go back and listen to some of my interviews or read some of the things that I've talked to reporters about, but New York is going to bounce back. It always has, and it always will. There's just so much talent here. There's so much infrastructure. People think this. You read these articles early on in the pandemic that New York City was dead. It's just not. It's not going to happen. There's too many good things happening here, and so I think you're going to see it bounce. I think you're going to see. You're already seeing it. Residential rental rates in New York rising at record levels. You're seeing. And you've seen it through the entire pandemic, housing values go through the roof outside of Manhattan. So all that's good. Now it's time for all the other asset classes to kind of bounce back, hospitality and office. And I think people are ready to travel. I think they're ready to come back to New York. And we've lost a lot of hotel rooms in New York City through the pandemic. There hasn't been a lot of construction going on. So what's stayed in place on the hospitality side is going to thrive. In my view, and office, I don't know. That's the one part I can't get my arm around. I do know that suburban office has thrived during the pandemic as people want to be closer to their homes and not travel into Manhattan. But maybe that reverses. Maybe suburban office goes back to what it was before, which was kind of a down and out asset sector, and downtown office starts to bounce back. There's great opportunities to buy office at really cheap prices right now.
Well, yeah. What percentage of people I've seen speculation will, about, so your office, Acres, is back in person. NYU is doing classes in person. Actually, this is the second semester that we've done it, and we'll do it in person over the summer. We have a REIT conference in person coming up on April 7th. Mm-hmm. So, the question about office is still open. We have to wait and see. Is there kinds of deals or parts of the country you won't go to? Things you say, don't even bother me, goodbye.
Yeah, like we were trying to stay away from illiquid locations. And what I mean by that is places where there's not a lot of transactional volume. There's not a lot of lenders and investors going in. I like to be in assets where they're readily tradable. So I'm not going to go to a tertiary location for the most part, unless it's a student housing property, of course, and then they exist around the university. But I don't want to do a multifamily property in the middle of, North Dakota, because there's only a handful of buyers and lenders that are going to potentially invest in that. So I don't have a lot of exits. Where I want to be is, right now is Texas, around Dallas, Austin, Phoenix, places where, there's a lot of economic growth and a lot of economic drivers and companies moving in, and people following. And I think you're seeing all of that in the Southwest and the Southeast of the United States. So those are good places to be. And I'm not turning my back, like I said, on the gateway cities, because I think they'll bounce back. But again, tertiary and some secondary locations where there's just not a lot of interest is where I stay away from, even if I can get paid twice the interest rate.
Okay. All very interesting. Are you today? You have acquired another company. And you're not going to tell me if you're going to acquire anything else. But do you want to get into billion-dollar deals, or do you feel that that's a different world? And do you want to grow?
We want to grow, but we want to stick to this middle market space. I think when you start getting into loans that are over $100 million, you're facing a whole new set of competitors like Blackstone, Starwood, some of the big players that are probably going to have cheaper forms of capital, going to be a little bit more aggressive. They have the ability to be a bit more aggressive. So middle market's a good place to be because if you're sort of an institutional quality, you can get a lot of capital coming into your money because it's a hard space to manage and you get better returns for the most part. But I want
Okay.
to grow our book, that's for sure.
Yeah, I understand. We do have NYU Shack has a partnership with Krefke, Commercial Real Estate Finance, which are exactly the people you're talking about,
Yes.
and and the CMBS market. Uh, and my final question: um, uh, How do you think? Did you think Shack helped you prepare for what you do, and has and things that our students should focus on?
I do. When I went to Shack, it was 25 years ago now. So it was a different program, and I'm sure it's much better now. But what I really took out of the program, and by the way, I speak at some other schools, so I can compare it to some of the other schools that I've been to. But I think one of the benefits for me at Shack was I went on a part-time basis, so I was working and going to school at the same time. And I was really working more as an analyst at the time. And I had professors who were knee-deep in it in the industry, who were very current on what was going on and had active projects, and so did I. So it was a great way to share ideas on what was going on and hear their perspective on it and share it with my classmates and talk about their perspectives because everybody was coming from different backgrounds. It was architecture, it was legal, it was finance, and we all thought about it completely differently. And I don't have those people in my world every day, but I had it at school. And so it was a great sharing of information more than anything. And I think the professors were in on that too. It was just, they weren't, I mean, certainly they led the classes, but it was more of a collaborative conversation type situation, which benefited not just us, but I think the professors too in the end.
Well, that part of it has not changed so much. I am a very strong advocate for the part-time students in our program. Some hyper academics, but I think it's wonderful to have sit in class next to somebody who worked for Acres or for Blackstone or for
Yeah.
even a smaller family business, but who was doing it every day. So with that, Mark, I'd like to thank you. As always, very informative and entertaining. We really appreciate your time. And students have further questions, they can contact me, and I'll forward them to Mark. And once again, thank you.
Thank you, Barry, and thank you, everyone.